The U.S. stock market is currently closed. At the end of yesterday's trading session on Thursday, October 30th, 2025, shares of Pfizer, ticker symbol PFE, closed at $24.31. That was a fractional gain, up just about 2 cents for the day, or 0.08%. But let's be honest, that flat, lifeless price action is exactly what investors have come to expect. The stock chart looks like a case of chronic fatigue. And yet, hiding just beneath that deceptively calm surface, a street fight is breaking out. Just yesterday, news hit that Pfizer is aggressively defending its deal to acquire Metsera, a smaller biotech, accusing rival Novo Nordisk of making a reckless and unprecedented proposal to snatch the company away. This isn't the behavior of a sleepy retired giant. This is the behavior of a company desperately fighting to buy its next act. And it tells you everything you need to know about the real story at Pfizer, which is far more urgent and volatile than that $24 closing price suggests. The common belief, the broad market expectation for Pfizer, has been set for 2 years now. The narrative is that this is the invincible COVID king. This is the company that, along with its partner biotech, saved the world, generated an unprecedented mountain of cash from its vaccine and Paxlovid, and has now settled into a comfortable life as a blue-chip dividend aristocrat. People see that staggering 7% dividend yield in their individual brokerage accounts and think it's a safe bond replacement. The expectation is that you just buy PFE in your Fidelity IRAs or let your Schwab intelligent portfolios allocate to it, and you just sit back and collect that massive check 4 times a year. The hard work is done, the story is over. But that reality is dangerously, completely wrong. The expectation is a fantasy. The reality is that Pfizer is a company in the middle of a painful, multi-year crisis. That 7% yield isn't a gift, it's a warning label. It's the market's way of screaming that it has profound doubts about the future. The real story here is a brutal 3-front war Pfizer is fighting just to stay level. On one front, you have the catastrophic collapse of its COVID-related revenues. The COVID cliff everyone talked about turned out to be steeper than a canyon wall, and revenue is falling precipitously. On the second front, you have management waging an internal war on its own cost structure. A sweeping multi-billion-dollar campaign to cut expenses just to protect margins. And on the third, most critical front, you have a desperate race to build an entirely new company on the foundation of its massive $43 billion acquisition of Seagen, trying to become an oncology powerhouse before the pressure from the other 2 fronts becomes so intense that the unthinkable happens. The dividend comes under threat. This isn't a safe harbor, it's a supertanker trying to pull a high-speed U-turn. Let's focus on the recent action because that's where the tension is most obvious. The entire market is now holding its breath for one date, November 4th. That's when Pfizer is set to report its third quarter 2025 earnings. And nobody cares about the headline number. The expectation from analysts is already dismal, forecasting a year-over-year earnings per share decline of nearly 40%. That's the COVID cliff in action. What everyone will be listening for is guidance. Management already set the full year 2025 guidance back in February, projecting adjusted earnings between $2.80 and $3 per share. The single most important question is, do they cut that guidance? Because if they do, the math on the dividend gets very, very ugly. The company just declared its regular 0.43 quarterly dividend on October 9th, marking its 348th consecutive quarterly payout. Management has sworn up and down that the dividend is a top priority. But that dividend costs the company over $9 billion a year. If adjusted earnings for 2025 are already pegged at, say, $2.90 on the high end, the payout ratio is getting dangerously tight. This is the central conflict that defines the stock. And this is why that Metsera news from yesterday is so vital. Pfizer is in a bidding war, likely for assets in the red-hot obesity treatment space, because it knows it needs more. It needs new growth drivers, and it needs them now. The Seagen acquisition was supposed to be the answer. Pfizer paid a fortune to buy its way into the top tier of cancer treatment, specifically for its antibody-drug conjugate technology. And the 2024 results reported early this year showed the legacy Seagen portfolio contributing $3.4 billion. That's a good start, but it's not enough to fill the $20 billion-plus hole left by evaporating COVID sales. So now they're back at the table, fighting Novo Nordisk for Metsera. This isn't an optional, nice-to-have acquisition. This is a we-must-secure-the-pipeline move. It shows an urgency that should make any self-investing individual using the SoFi Invest platform or the Robinhood app pause and reevaluate the safety of this stock. While this pipeline race is happening, the internal cost-cutting is massive. We're not talking about trimming the travel budget. Pfizer is in the middle of a sweeping cost-cutting push, aiming for $4.5 billion in net savings by the end of this year alone. On top of that, there's a manufacturing optimization program looking for another $1.5 billion by 2027. Back in April, the company lifted its total savings target to a staggering $7.7 billion through 2027. This includes major cuts to R&D and administrative staff. The expectation is that this will make the company lean and efficient. The reality is that this is a sign of deep distress. You don't perform this kind of radical surgery unless the patient is in serious trouble. They are trying to carve out enough profit from the old business to fund the new one. If you look at who owns this stock, you see the conflict playing out. Check the institutional filings. Yes, the biggest holders are the giant passive index funds. You'll see Vanguard and Fidelity with its Fidelity 500 index fund and iShares. They have to own PFE because it's in the index. Their ownership is automatic. It's the Fidelity ETFs and other broad market funds that many people use for their online investing. But look closer. Look at the active managers, the stock pickers, who run Fidelity mutual funds or provide Fidelity wealth management services. Filings from mid-year showed that some of them, like Mises Large Cap Value, were reducing their positions significantly. The passive robo-advisor money, like Schwab Intelligent Portfolios, is staying put. But the active human managers are showing signs of nervousness. They're looking at the risk profile and comparing it to something like Nvidia stock or Apple stock and seeing a very different kind of challenge. They're questioning the ability of this company to execute. So what does Pfizer actually do now that the COVID chapter is closing? The expectation was that it was just a vaccine company. The reality is that it's trying to pivot to be a highly focused oncology and inflammation and immunology company. The old Pfizer was a sprawling giant with everything from consumer health, which it spun off, to legacy drugs. The new Pfizer is built on its existing blockbusters like Eliquis, a blood thinner shared with BMS, and Prevnar, a vaccine for pneumonia, and now the new high-tech cancer drugs from Seagen like Padcev and Adcetris. The entire bull case, the entire hope for the future, rests on these non-COVID products ramping up faster than the old products fall off their own patent cliffs and faster than the COVID revenue disappears entirely. It's a race against time, and it's happening while the government, through the Inflation Reduction Act, is actively working to implement price-setting policies, what Pfizer calls the pill penalty, that could harm the profitability of its next generation of medicines. This brings us to the core question for anyone looking at this stock on investing sites or through their interactive broker's account. Comment below if you are holding Pfizer primarily for that 7% dividend or if you genuinely believe in their post-Seagen oncology pipeline. Because right now, those two ideas are in direct conflict. Looking forward, the tension between expectation and reality becomes the entire story. The bullish expectation is that management pulls this off. The $7.7 billion in cost cuts are successful and stabilize margins by 2026. The Seagen integration proves flawless, and its cancer drugs become the new standard of care, generating tens of billions of dollars in new revenue. They win the Metsera deal, giving them a shot in the obesity market. The non-COVID portfolio, Vyndaqel Nurtec, continues to post strong growth. In this scenario, the dividend is saved, the earnings trough is in, and the stock is recognized as an incredible value investment. Those who bought at $24 on their SoFi trading platform or using the Robinhood stock trading app look like geniuses. The company successfully transitioned from a COVID-driven windfall to a sustainable, leaner growth company. The bearish reality is far darker. This is the value trap scenario. The reality is that the COVID revenue crash is simply too deep and too fast to fill. The Seagen integration hits snags or it's